Hi, I'm Carlos Ström, manager of the Paleo Fund and author of the book Paleo Trading, How to Trade Like a Hunter-Gatherer. It's been a while since I made any of these videos. I think the last one was in May. It's been summer holiday and I've been busy with the establishment of and the launch of the fund and to start trading the strategies outlined in the book. I just want to underline that this is not to be considered an investment advice, and neither is the book. It's a tool for the book is a tool for people who want to trade themselves and want to get some kind of tips to get them going about how to do it. But these videos are for short comments about the markets, which I kind of watch every day, most of the day. I start the days early at about 7 or 8 o'clock, looking at the Asia and futures market before Europe opens, and then it's a rather busy session until lunch here in Europe. And then it's quiet until about 2 o'clock Central European time, when the Americans wake up, new news and new money enter the market, and then of course we have the busy US session until they again take lunch at about 5 or 6 Central European time. So these kind of intraday cycles in the market, I describe them in the book, and they are to be traded in slightly different ways. But at least for being a short-term trader, it's all about being where the action is and being in the market when it's active. And when it's not active, you simply have a larger chance of getting wiped out of your positions, at least if you have very tight stop losses. So all of this is described a bit in the book, and since I launched the fund, I've had to endure the kind of markets that currently are there, at the same time as we have been using some time to get used to new systems and new ways of trading and the employment of various strategies when you are doing it with larger size than most people out there do. But they all work. Markets are about adapting, and then of course at the other side of the screen you have the market itself, and that's what we're going to talk a little bit about now, because the markets are not as easy these days. They've been a bit tricky. We have some parts of the markets that are in clear uptrends, and I guess if you're a mutual fund investor watching this for fun, the thing I can say to you is that the markets are still mostly in a clear uptrend, and there's no reason to take out money of your funds. We seem to be in a rather good market and in a benign phase. That being said, we see volumes drop off a lot in the more illiquid parts of the markets. There have been a lot of listings. Not all of them have been very good. Not the average listing at various stock exchanges have not performed very well in the market, and there have been some bubble tendencies in some parts of the market, whereas others look more healthy. But to sum it up, many of the large indices have more or less moved sideways for months. I'll pull up and it's not only geographical areas but also subparts of the market. So if we can look at the chart for the Russell 2000 ETF, which is the 2000 smallest of the 3000 largest US stocks, you can see that we have now moved 8 months sideways in a fairly narrow range, and some US technicians also call this a stealth correction, because if you take the S&P 500, and we'll look at that soon, you can see that the index is strong, but if you look at the average stock of the S&P 500, it's down. It's had corrections of more than 10% during this period. So the breadth of the market is not pushing as strong as it did. There are more divergence within market and market segments. So and this is also predominant if you look at most of the European exchanges. I know that the Oslo Stock Exchange, that's my home exchange here, have been fairly strong due to the oil price mostly, and we get to that as well. But if you look at other indices, Sweden have been moving sideways. The Germany DAX, I'll pull it up here, Hana has several months in a fairly tight range, and we see that in a lot of other markets as well. As for the oil price, energy prices, prices have always captured, you know, media's attention. There's a lot of news there all the time. But the oil price itself, and we see it for Brent North Sea oil here, have been moving more or less sideways within a $10 range, between 65 and 75 for the last half of the year also. And if we look at a broad index ETF of energy companies, they've been strong lately, the last few days, and especially some of them listed in Norway, but that's mainly because of the gas that they produce. But if we look at the XLE ETF that's listed in US, which contains the big oil companies, it's been fairly weak, and it's actually been more sluggish than the oil price itself. Of course, a large theme within this sector is a shift towards green energy, and that's something that doesn't come cheap or doesn't come by itself. So that's an interesting theme for some. And of course, we did have a boom in green stocks earlier this year, but it topped out in around February. And since then, it's been actually a fairly deep correction. Seems to be still going on in many of those names. So, which part of the markets do I think is strong? Well, I did post some charts on Twitter yesterday of one of the strongest subparts of the market, which is semiconductors. Everything you need to make chips that go into all kinds of electronic, including the things I use to make these videos up here in the mountains today. So semiconductors have been very strong, but some of the charts within the sector is starting to get banana shaped. And I've wrote about that kind of setup in the book, Paleo Trading, How to Trade Like a Hunter-Gatherer. And I get some questions, what does this paleo mean? And actually it's from the Latin word for Paleolithic times, which is the Stone Age, when we were living, humans were living like hunter-gatherers. And that's the underlying theme of the book, that it pays to be deploying hunter and gatherer strategies when you're trading the market as well. Well, anyway, the setup is described in, I think, chapter 7.5 in the book, which I call the blow-off top, which is sometimes you see accelerating uptrends. Uptrends have been in force for a while, and the reason, of course, behind uptrends can be very good, and they are in semiconductors. I'm very bullish to semiconductors, but sooner or later you get into a phase where everybody is in, and a lot of shorter term money comes in, often at the end. So the key is not to sell these moves too early, but to ride them with a tighter and tighter stop as they move up. Because when they finally go into another phase where, you know, everybody is long, you tend to have many months of consolidation, at least, usually a correction of considerable percentage points before the uptrend resumes. So if you don't want to wait for that, if you're a more shorter term trader, it pays to read that setup and see if you can recognize it in the market. I don't have any, as we speak, short positions in these names. I have had some longs on. I actually have a long in Intel right now. It's a dog, but that's a shorter term trade. I had ASML and several of them, but not as long as one should have hoped, which kind of brings me back to what I'm doing right now. I've been using these months since we launched the fund and everything was ready, about the same time as the many markets indices started to go sideways at the end of Easter. So I've been mainly short-term trading, getting to know all systems, getting to know the strategies in practice, and how to deploy them with the larger capital. But now entering into a phase where I plan to have more and larger positions on in the fund at the same time as we do short-term trading. But also these positions are fairly short-term, so I at least in this market phase where it's not such a clear uptrend, I stay opportunistic and have very tight stop losses and in mainly liquid names. But I mentioned semiconductors. That's one part of the market that I see is very strong. Another one is cybersecurity. So we have many cybersecurity stocks that have been very strong. There's many small, medium-sized companies there, and some larger. There's some ETFs of that as well. So that's an interesting space to look into. And of course you have lots of other bottom-up plays that can be interesting. But what I mainly look at is sub plays within the tech sector, and then I trade other parts of the market from time to time. But also the main position is in index futures, which of course captures the larger FANG names. That's have been the ones that have been pulling both the NASDAQ 100 and S&P 500 up. If we look at the chart of the S&P 500, we can see that it's still above. It's been some rough days now. It's been, or I wouldn't call it rough, but it's been sluggish. There have been red days, a very short, or at least a sluggish correction, as that's taken the index down, S&P 500, below its 10 and 20, no, it's 8 and 20-day moving average, which is averages I used to follow now. But it's still above the 50-day moving average. So it's still within an uptrend. But it's been a very long time now without a meaningful correction of the S&P 500. And we're entering a part of the year that usually brings some more volatility, so we'll see how that goes. You got to stay a bit more tactical now, at least when it's below the 8 and 20-day moving average. As for the NASDAQ 100, it's a bit stronger than even the S&P 500, but it is below currently its 8-day moving average. Above its 20-day moving average, and it's a bit above its 50-day moving average. And it's also been a while since it had a meaningful correction, even though the volatility have been a bit stronger, a bit more predominant in the NASDAQ than in the S&P. So where do we go from here? I don't know. I see the uptrends. I see that the market is not as broad as it was, so it hasn't been a very strong uptrend. Many of the markets I trade around here in Europe are not in uptrends. Some are rolling over a bit more actually than others, including Sweden, which is interesting. And we have sub parts of the market that of course trade in tandem with the sectors that you see in the US, such as industrials or other parts of the market that seems to be in a more corrective phase, at least right now. So the thing is to be light on your toes always. At least I like to have an active meaning about every position I hold, and I value the opportunity to turn my position around or liquidate it very quick. So I want to stay tactical and employ these strategies for the long haul. And there will be times where you should be all in, geared and long for several days or weeks at a time. And there's other times in the market where it pays to be totally off or even net short, of course, in downtrends. But right now we're in a very mature uptrend. I think that kind of sums it up. And I heard some macroeconomists talk about this, that it always reminds you, it's never exactly the same, but coming out of this COVID crisis and all the stimulus that's been driving the market up, it kind of looks a little bit about when we were coming out of the financial crisis, where also stimulus have been very plentiful. Then they come into a phase where that stimulus is if not totally removed, it's being reduced, and that removes one of the, if not pillars, and at least one of the factors that's pushing the market. So if you look back at 2010, 11, 12, it wasn't bear market, but it was, sideways, range-bound stock pickers market, and that's not bad. But it's not as good and not as easy as we've been used to for the last 1.5 years, perhaps. So on that note, I want to say thank you for listening, and I guess I won't post any of these videos every week, perhaps not every month, but every once in a while. I'll see you again. Bye.